I think let's focus on JK Tyres now. Q4 was a decent quarter for them. They saw a good growth in profits, healthy margin expansion, but the top line growth was in low single digits, so that was a problem. But the important part also is that their balance sheet has improved quite a bit. Net debt has declined substantially over the past couple of years. Raghupati Singhania, the chairman and managing director at JK Tyres and Industries, joins us now. Mr. Singhania, thank you so much for joining in. You know, it was a decent end to the year, but the problem still is that top line growth continues to be in low single digits. What is the expectation for FY25? What is the growth that you think the industry and JK Tyres can eke out?
Look, the business is on a good keel at the moment, and the tire industry is looking up. Demand, if anything, is going to improve in the coming year. Therefore, we are looking at a bright 2025. 2024 was an excellent year for us. We had record sales, record margins, and so on. And we are looking, going forward, we're looking at a good traction in the year. The tire industry is expected to grow about 6 to 8% across the board. And so is the vehicle industry going to, particularly the passenger car, 6 to 8%. So that should give us a good traction. The truck industry, of course, is a little flattish and will be a little flat during the year. It may have quarter to quarter up and down, but in the end of the year, it will land up more or less flat. The OEM I'm talking. I'm not, replacement market is different story. Replacement market is moving all right. And so that is the growth forecast for the industry. We are looking at maintaining the growth momentum and trying to work on about 8 to 10% increase in our sales in the year for 25, and hopefully trying to maintain decent margins.
Okay, so you're talking about a 6 to 8% growth for the tire industry in FY25. Got it. I want to talk a little bit about exports, because for the full year they were flat, and we do know that there are a lot of markets which are under pressure. What's the expectation for FY25? Any recovery in sight in the export markets?
Indeed, very much so. As a matter of fact, as you rightly said, 24 was flat. But the last quarter of 24, Jan-March, was a very positive upsurge in exports. So, in fact, and even in the current quarters, we are looking to a growth in export. And we think this year forward, the export should grow. And because, look, what is happening is that the markets like USA, that are cleaned out in that sense because they're overstocking and so on over the years. They've cleaned out. The geopolitical disturbances are very much there, as we all know. But I think people have learned to live with it. And therefore, despite that, business is trying to get as usual. And that's what will give us an uplift. As a matter of fact, we are seeing demand growth even in LATAM and in the US for our tires. And we are quite hopeful of a good export surge in the year.
Well, during the past fiscal, JK Tyre raised close to 500 crores by the QIP route, and that's what helped in deleveraging. How much have you been able to reduce your debt, and how much more can you reduce it in the coming fiscal?
In fact, that's a very important question. I'm glad you're asking me, because that's an important agenda we had of deleveraging a balance sheet. In fact, if you might recollect, we have done capital raising in 2 tranches. We had first done a place with IFCI, 240 crores, and another 500 crores with the QIP this year. And the two together, our debt has come down substantially by nearly 18% during this year. Our net debt has come down by 18%, and our debt equity now stands at 0.85 to 1. So, in fact, we are quite happy about our debt, and the debt is absolute number of debt is nearly 3,100 crores. We got 3,700 crores, not 3,100. Sorry, what is that?
Okay, so you've reduced your debts significantly, which is a good thing. But I want to come back to growth rates, right? Why is the tire industry growing in single digits? This is at a time when EVs are picking up, SUVs are picking up. Is it fair to assume that the entire passenger vehicle and commercial vehicle industry will see very slow growth in FY25, given what you are forecasting?
You see, please analyze the auto industry. The auto industry is growing, but the number, what we are seeing is percentage-wise, is not all that jazzy, by the way. They are still single digits. And the total auto industry, we foresee to grow at 6 to 8% at best. And within that, if we look at passenger car segment, that will grow a little better, maybe 7, 8%. The CVs are almost flat, even going forward during this year 25. It will have a little waxing and waning over the quarter over quarter, but ultimately is more or less flat. The two-wheeler industry, of course, will grow. Tractors are very slow growth. They will grow for sure, but very slow growth. So therefore, that explains. And secondly, please appreciate that the vehicle industry is but a component of the total tire demand, because it is the OEM which is directly leading to the vehicle production. The rest is derived demand that is in the replacement market. So if in the bigger picture, holistic picture, I gave you the figure of 6 to 8% of tire industry growth.
All right, Mr. Singhania, let's talk about both your subsidiaries then. The Cavendish as well as the Mexican subsidiary, which is Tornel. How are the subsidiaries doing? Is there any kind of recovery, particularly in Tornel, after the slowdown that we saw last year?
Yes, indeed. Firstly, let me address the Tornel first. We are seeing the Mexican economy had a little bit of a slowdown last year, but now it is marginally picking up in the low single digits. And incidentally, we are the largest market shareholder for passenger car radials in the Mexican market, our Tornel company, and we supplies. And we are seeing now some growth coming back to the low single digit. The economy is supposed to expected to grow at really 1.5 to 2%, mind you. So that can be some indicator. But still, the auto industry is growing because based on exports out of Mexico to the US in particular. So that also adds to the traction of the demand. But to address your point more squarely, Tornel is growing. We have been able to improve our sales bit by bit. And looking forward also, we expect to improve by 5 to 7% in the coming year, our turnover and profitability. On the Cavendish front, we have done well for the Cavendish. In this year itself, we have had nearly 58% growth on year-to-year basis. And even the profit was nearly multiple X, may I put it, percentage-wise is unwieldy. So we have grown very well. And we propose to continue to maintain our growth momentum across the Indian businesses.
Okay, that's good to see that there is a recovery in your Mexican business. Two questions on margins, Mr. Singhania. One, will you be able to sustain your margins at 14.1% exit margins of FY24? And two, will you be able to pass on the higher raw material prices, both rubber and crude, to the consumers?
Yes and no. Firstly, we have been able to maintain our margins on the back of a couple of things. One is the raw material story has been rather stable. I mean, they're flat, if I may. So there's not much of an upheaval in the raw material front. On the other hand, we as a company focused more on premiumization of our product range. With the result, our realizations per ton improved, relatively higher than many. Number three, some marginal increase in selling price revision was done in the Q4, based on very marginal, but anticipating these increases. And even now, going forward, we are expecting some increases in raw material prices in the Q1 of this year. And we are also looking at some price revisions going forward, marginal. But the question of how and why we'll be able to maintain our EBITDA, by and large, is banked upon on three things. One is, as I said, premiumization. The thrust is on. We are undertaking expansions, the outcome of which will be available to us now. And in that expansion, we are moving more and more towards premiumization. By this, I mean, for instance, 16 inches and above PCR, passenger car radials. Earlier, we had a capability of about 25% of these premium sizes. Now we already have a capability of about nearly 45%. And going forward in a year or two's time, we will be able to have nearly 60% of premium production available. This will add to the margin gradually going forward. So therefore, based on this, we are confident that we should be able to perform reasonably well even in the coming periods.
Okay, Mr. Singhania, thank you for joining us and speaking to CNBC TV18. The street likes what they have seen because the stock in pre-opening, the last time I checked, was up about 5%. So yes, there will be slow growth, about 6 to 8% for the industry, but JK Tyres will outperform the industry is what Mr. Raghupati Singhania is saying. But